think I'm also not prepared to call it wolf. I think going forward this week, we should see it continue trading between that the tight place it's been trading over the past couple of weeks, and with no CBK participation expected in the markets, I think I'll stick to. We don't expect a lot of movement on in the shilling dollar.
Of course, there are various factors to consider, though. I mean, on the domestic front, we've got fundamentals, that whole strong economic growth story, supportive of strength on the one hand. On the other hand, we've got that international currency movement and playing field to consider as well. Most particularly, the kind of euro-dollar shifts we're seeing right now. How closely are you monitoring things on that end, where dollar weakness seems to be, for the most part, on the cards?
I think, of course, the Kenya shilling is affected by global movements. So if we see a global weakening in the dollar, that should affect the Kenya shilling positively.
We know that what happens every time the shilling does get too strong, though. We've intervention coming in. So that's still very much a factor to consider, yeah?
Yes, it is. If we do expect the CBK to come in.
We've had the central bank, though, repeatedly say that it's denied that it's coming into the market to boost the currency or, to kind of stimulate things on that end. It's buying dollars instead for government needs. But the whole debate is raging globally on whether we should see intervention from, bodies like central banks globally in particular. What policies, in your view, would be appropriate right now?
I think for Kenya, our economy is rather at a delicate stage coming out from the 2008-2007 slump. So I would agree with the central bank manipulations in the market.
Is reserve accumulation the only option that they've got available to them at this stage?
Pardon?
Is reserve accumulation the only option they've got available to them at this stage of the game, or could we see other methods of intervention coming to the fore?
At the moment, I think that is the most direct method available to the central bank.
Is there at all the opportunity to loosen foreign exchange controls in Kenya and using that as a mechanism to see the shilling depreciate?
No, not at the moment. And looking at the budget reading for this financial year, there were no indications to indicate that.
Let's move over to the bond market. Fixed income traders like yourself seem to be focused on this week's auction of a 10-year treasury bond that's worth 15 billion shillings. Anticipated outcome there?
Basically, central bank has been coming out and saying they expected to come in at basically market levels of about 7 to 7.5. But market sentiment on the ground is quite different. Most market participants expect the paper to come in at levels of between 7% to 8.5, with a cutoff maybe going above 8.5%.
Kenneth, have you been noticing any trends, with the kind of interest that's re-emerged on the equity side of things? Have you noticed any trends in terms of attention diverting away from the fixed income space at all?
Yes, of course, we have seen that. We've seen fund managers who participate in both the equity and the fixed income market, mostly diverting the attention to the fixed income market. But also the decline in the fixed income market can not only be attributed to the rally in the equities market, because what we've been seeing is with fund managers, they're also being driven away because of the low interest rates we're seeing in the market, which with the T-bills having a negative real return. In fact, we're seeing some fund managers looking for alternative investment avenues and investment vehicles, such as credit-linked notes, for example.
What's your outlook on the interest rate front and the direction you see the Central Bank of Kenya taking in that regard, where just today we've seen an IMF report being released and suggesting that we should see sub-Saharan African countries moving away from expansionary policies?
Going forward, the central bank is really trying hard to keep interest rate levels at the low levels we're seeing currently. But with the heavy borrowing appetite that we expect for this budget here, that will be pretty high, because we've seen with every new issue every month, interest rates on benchmark counters rising.
Well,